Hello guys! Investing in the stock market is an excellent way to grow your wealth. For long-term investors, stocks are a good investment, even when there is a high volatility in the stock market. A stock market downturn can only mean that our stocks are on a sale and you can buy them in a good price, because in the future there might be very good returns for your wallet. But how do you actually get started? Investing in the stock market can be as simple as opening brokerage account and choosing a few individual stocks and mutual funds. The whole process can be done online, and actually there are some companies which are for a small fee can invest your money in stocks for you. In this video we'll be talking about some steps on how to get started investing. In this channel, as a beginner investor, I'll be sharing with my experience, and I'll be sharing with some ideas on stock market. If you want to follow these videos, just subscribe to channel. The step 1. Determine your goals. Before getting started to any kind of investments, you should make sure that your financial situation can accommodate these activities. Your financial baggage includes from income to debt to household expenses. I would suggest you to organize your financials in some mobile app and write down all your expenses and income, and make sure that you'll have a side money for investing. It is also helpful to consider your goals and ask yourself some questions, like, are these investments for your retirement, or is this money for short-term goals like several months, or long-term goals like 1 year and more? These questions can help you consider your goals and help making decisions in the stock market. Investing makes the most sense for the longer term. You generally don't want to invest the money that you will need in a few months, because you might lose money in a downturn period. The step 2, you want to decide how you will be investing in stocks. There are several ways to approach stock investing. The first, you might be the do-it-yourself person and you want to choose your stocks or stock mutual funds yourself. Keep watching, I will be telling the things hands-on investors need to know. The second type of investors are those who say, I know the stocks can be a good investment, but I would like someone to manage this process for me. In this case, you might be a good candidate for robo-advisor companies. These companies offer their services for a certain amount of fee and manage your investment strategy. But I'd like to mention that you should carefully choose one. Once you have a preference, you are ready to go further. The step number 3 is opening a brokerage account. Generally speaking, to invest in stocks, you need an investment account. For the hands-on types, this usually means a brokerage account. For those who would like a little help, opening an account with a robo-advisor is a sensible option. I will break down both processes further in the video. An important point, both brokers and robo-advisors allow to open an account with a very few amount of money. There are options with no minimum account too low. The do-it-yourself option, opening a brokerage account. An online brokerage account likely offers you the quickest and the least expensive way to buy stocks, mutual funds, and other types of investments. To choose the right brokerage account, you will want to evaluate brokers based on several factors like costs, trading commissions, account fees, investment selection, and investor research and tools. The passive option is opening a robo-advisor account. A robo-advisor offers a benefit of stock market investing, but doesn't require its owner to do the legwork required to pick individual investment. Robo-advisor services provide complete investment management. These companies will ask you about your investing goals during the onboarding process, and then build you a portfolio designed to achieve those aims. This may sound expensive, but the management fees here are generally a fraction of the cost of what a human investment manager would charge. Most robo-advisors charge around 0.25% of your account balance. And yes, you can also get an IRA at the robo-advisor if you wish. In this case, You also want to compare commissions between robo-advisors and choose the right one for you. The step number 4, know the difference between stocks and stock mutual funds. If you are going to do it yourself, don't worry. Stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these two investment types. The first, stock mutual funds or exchange-traded funds. In other words, ETFs. Mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that track an index. For example, a Standard & Poor's 500 fund replicates that index by buying the stock of the companies in it. In simple words, when you invest in a fund, that means you also own a small piece of each of those companies. You can put several funds together to build a diversified portfolio. Note that stock mutual funds are also sometimes called equity mutual funds. The second is individual stocks. If you are after a specific company, you can buy a single share or few shares as a way to dip your toe into the stock trading waters. Building a diversified portfolio out of many individual stocks is possible, but it takes a significant investment. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. For the vast majority of investors, particularly those who are investing their retirement savings, a portfolio comprised mostly of mutual funds is the clear choice. But mutual funds are unlikely to rise as some individual stocks might. The upside of individual stocks is that a wise pick can pay off handsomely, but the odds that any individual stock will make you rich is exceedingly slim. The step 5. Set a budget for your stock investments. New investors have two questions in this step of the process. How much money do I need to start investing in stocks? And how much money should I invest in stocks? The amount of money you need to buy an individual stock depends on how expensive the shares are. Share prices can range from just a few dollars to a few $1,000s. If you want mutual funds and have a small budget, an exchange-traded fund, ETF, may be your best bet. Mutual funds often have minimums of $1,000 or more, but ETFs trade like a stock, which means you purchase them for a share price, in some cases less than $100. This mostly depends on your financial situation and your strategy for your investment. I would suggest to diversify your investments into several types, like individual stocks, ETFs, bonds, and maybe bank deposits, so you have a growing investment even during a period when there is a high volatility in the stock market and there is downturn. And the sixth step is actually start investing. Stock investing is filled with lots of approaches and strategies, yet some of the most successful investors have done little more than stick with the basics. That generally means using funds for the bulk of your portfolio. Warren Buffett has famously said a low-cost S&P 500 index fund is the best investment most Americans can make, and choosing individual stocks only if you believe in the company's potential for long-term growth. If individual stocks appeal to you, learning to research stocks is worth of your time. If you plan to stick primarily with funds, building a simple portfolio of broad-based, low-cost options should be your goal. If you decided to open a brokerage account but need more advice on choosing the right one, leave a comment on this video and let's discuss. And finally, if someone asks me an advice about investing for beginners, I would say investing isn't as hard or complex as it seems. That's because there are plenty of tools to help you out. One of the best is stock mutual fund or exchange traded funds, which are an easy and low-cost way of investing in stock market for beginners. An S&P 500 fund, which effectively buys a small pieces of ownership in 500 of the largest US companies, is a good place to start. And the last thing I'll say on this, investing is a long-term game. So you shouldn't invest the money that you will need in the short term. That includes a cash cushion for emergencies. The goal of any investor is to buy low and sell high. But history tells us you're likely to do that if you hold on to a diversified investment like a mutual fund over the long term. No active trading required. That's it for today. If you like this video, press the like button and subscribe to the channel for more videos. Bye!